Raydium can afford to do things like invest in R&D, do partnership integrations, more marketing, launch their own Pump.fun competitor. And it's because of their previous success. So I think it's not all gloom and doom because of this optionality that their cash piles give them.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Hey guys, welcome back to another episode of OX Research. Before we jump into the show today, I wanted to give another quick reminder. DAS, it's coming in a couple of weeks back to New York City. If you haven't already and you want to check it out, you can get tickets with our discount code 0x10 at the link in the description below. So check it out if you want to meet some cool folks from the research team here at Blockworks, or interesting individuals from around the industry, see some live podcasts, just meet some great people, learn a little bit more. Go ahead and check it out. That's 0x10 at the link in the description. We'll see you at DAS, hopefully. Jumping into the conversation today, we've got Carlos, Dan Shapiro, and Mark Arjun. It's a full sort of research team group up today. The market has been not the most exciting. Again, I think we're just in a little bit of this sad and disappointed time following a bit of craziness in, I guess December, January, post-election. We've given a lot of that back. One of the big pieces of news coming out of this weekend is this note from Trump about the crypto reserve / stockpile. He seems to use those terms kind of interchangeably, but the big piece of news that hit the timeline was like Bitcoin, ETH, and then XRP, Solana, and ADA would be potentially part of some kind of crypto reserve or stockpile for the US. No details beyond that, but it sent the charts on a bit of a whirlwind. I guess I'm curious your guys' thoughts on, like, is this just positioning from them? Like, are insiders trying to trade this? Is it like, what are the odds we think this actually gets kind of implemented in some real form? It's very vague at the moment.
I guess I can go first. I think like everybody in the crypto industry, regardless if it leads to a pump or not, agrees that only Bitcoin should belong in a crypto strategic reserve. I've seen some takes that are plausible that maybe Trump did this to like gain leverage, like in terms of negotiation, like start with this bunch of altcoins and then like gradually go towards only Bitcoin. But at the end of the day, it's not great that announcing this on a Sunday, pumping altcoins just for a day. Like it was, I think like it was one day after the 7.5 million soul unlock, which like just optically doesn't look good. And so, it just not great overall. And I think like eventually if a crypto strategic reserve is implemented, it should only be Bitcoin, in my opinion.
Yeah, I'm just gonna second that. Like, I think it's kind of ridiculous to have anything but Bitcoin considered at this moment. And I mean, even Bitcoin is still gonna be a bit of a stretch, right? Because it's kind of unprecedented. But I mean, it's plausible. But for the others, and I mean, the trend was that they seem to be all American based, whatever that means. I don't know how that's defined, and I don't even know if that's true for them necessarily. But the government should not be buying crypto assets like that on the long tail. I mean, I know Japan, during the last downturn, were buying like stocks for their quantitative easing, and that was a bit extreme, and it seems to work out. But I mean, even that is more palatable than some of these other coins. The Sunday announcement, I've heard like, okay, he announced this on a Sunday. He did the meme coin drop on a Sunday. But then I remember he also did the tariff announcement on a Sunday. I think he just likes to do these things when he knows there's no other major news going on, so that it gets a little bit more of attention. I don't know if it was necessarily insider stuff. My bet is, there were some people who knew, but I just think he likes to do these things on a weekend.
Yeah, I mean, after the Trump meme coin, right? Like, I think you have to think all bets are off in terms of what Trump's going to do. And I mean, I agree with both you guys. Like, if there is a strategic reserve or stockpile, whatever it is, it should just be Bitcoin. yeah, and then the Sunday thing, I don't know if it's like by design, like, to do it when the market's illiquid. I don't know if it was by design to do it before the day of the Sol unlocks. Um, you could argue the other two coins he mentioned were both like top 5, top 10 cryptos. So I mean, there's a couple stable coins, or I mean, there's Tether, and I believe Liquid Staked ETH, Lido's LST ETH is in the top 10 too. So like really, he picked just like Bitcoin, ETH, and those 3 coins are pretty much some of only the 5 actual like non-stable coin or liquid staking tokens in the top 10. So maybe that's what it was. I heard that explanation. But then there's like a part of me that thinks that Trump's just kind of shooting from the hip and there is no like plan here. Nothing's kind of by design. Maybe he was just like, let's put out a crypto tweet, keep the crypto guys happy, right? Like I don't know how much one should look into it, but what I will say is I do think that the market completely lacks a narrative right now. Really, we had the ETF narrative, and that kind of got us out of the bear market and up to 70K. And then we had Trump getting elected, which was the next big run up. And it just seems like without a strong narrative, Bitcoin just kind of chops sideways. So I think the market is hungry for one, and that showed that. Look, like the market is, I think, positioned very heavily, not necessarily short, but whether you want to call it flat, short, um, there's essentially no leverage in the system right now, and I think funding rates on Bitcoin have actually gone negative for a couple like lower hourly or 4-hour periods, which is very, very rare. So I think if there is a positive event, like I think that just shows you that like I think the tide will switch quickly, but as of now, it's like I don't. It's tough to know what that narrative is going to be, other than like an actual stockpile announcement. I did hear supposedly on like Eric Trump's Discord or something. You mentioned that on Friday they're going to announce no taxes for American-made cryptos for long-term cap gains. So like I don't know, but at this point, I think we're just gonna chop sideways until and down, unless there's like a new narrative that takes hold.
Yeah, I think good points all around. It is a bit ironic to see the like focus on this Doge initiative and trying to cut spending, and then at the same time talk about some potential like maybe purchasing of like just cryptocurrencies, outside of maybe Bitcoin, which like if you guys mentioned, I think the general industry sentiment today is that it would be a bit silly to include really anything other than Bitcoin at the current moment. So that's a bit funny just to see those two like things at play there. And I guess maybe the other big thing now that's weighing on people is just this kind of decline in interest and slumping of prices has led to overall pretty massive reductions in on-chain activity. We've seen that sort of across the board. REV numbers are down for Ethereum, for Solana. Obviously, like following the Trump token launch, like that was a massive spike of a day of just overall activity fees captured. And we've sort of seen that trend continue now. People are just disinterested. The trend has been not favorable to like continuing to trade meme coins, what have you. We wanted to have Carlos on a few weeks back when he initially dropped some details on a Solana DEX landscape breakdown. But now that I think the narrative has switched a little bit more towards, we're seeing more conversation around fundamentals and fundamentals-based investing, which not that you can necessarily, perform great, you're not going to see a 2 to 3x while Bitcoin is maybe heading to the downside, but you might outperform other things by having some sort of fundamental kind of strengthening underneath it versus just being a kind of valueless thing with no revenues or earnings to support your token. But I want to dive into that point around the Solana DEX landscape, like where we're going. If we assume that like activity is falling off, like things are changing, like what are I guess looking forward into the future, like what should people be thinking about if you're surveying, Sol is still today one of these top on-chain economies. And so if you're looking out over the next, maybe 12 months, if not longer, it's going to be important to understand, who are the key players today and who you might think will be the key players going into the future.
Yeah, absolutely. So first of all, I think like we can all agree that Solana has become the dominant on-chain trading hub. There are over 27 million tokens now, over 50K tokens deployed per day through Pump.fun alone. And so I think like people have been trying to navigate the Solana DEX landscape and who are the key players here. Like if you look back at 2022, 2023, Orca was the dominant DEX on Solana. But then like at the end of 2023 and all of 2024 and this year, yeah, exactly. This chart that we see here, Raydium has been gaining basically a lot of market share from Orca and is now the dominant DEX with around 60% market share. And then you can see like they absolutely dominate volumes, and it has been on the back of meme coins. So I think like if we go to the next chart, we'll appreciate it a lot better. Like we can see that starting at the end of 2023, meme coins started to gain prevalence on Solana DEX volumes. And this trend only accelerated in April 2024 when Pump.fun launched. As you can see, like in the past 90 days, like 60% of sold DEX volume has come from meme coin pairs. And this is a trend that has become basically steady since late 2024. And so I think like looking forward, like if you think meme coin volumes are like down from here, that definitely affects Solana's total DEX volume and real economic value as a result, because a lot of the rev that Solana generates comes from trading activity. And meme coins are a huge part of that because when you trade meme coins, there are a lot of contentious transactions and also a lot of arbitrage opportunities. And that's what generates a lot of the both priority fees and GTIPs that you see on Solana's real economic value. So I think like in the next chart, we have like a really cool heat map that basically just shows you like yeah, exactly this one. This just shows you like the DEX market share by asset type. So what I want to highlight here is a couple of things. First of all, you can see that Raydium dominates meme coin volumes with around an 80% market share. What's interesting here, and I think we'll discuss that a little bit later, is that Raydium dominates both Pump.fun and non-Pump.fun volumes with around 79 and 78% market share, like respectively. And also, like Raydium is the primary beneficiary from increased on-chain like retail activity, but it is also the DEX that suffers the most when we have periods of like downward pressure and like down like slopes in activity, because it is the DEX that benefits the most from like this meme coin mania kind of thing. Another interesting thing is like if you look at Liquidity, it is the fourth DEX by overall volume, but it is actually the leading DEX in the Sol USD pair. I think this is interesting because it highlights like as a DEX, they have focused solely on the Sol USD pair, providing deep liquidity there, and they have managed to gain traction in that market while like leaving out all other things. And they have a very interesting mechanism where they have like protocol owned liquidity. But like, yeah, we can dive later into that if that's interesting. Like the final thing that I would note here is Orca. I mentioned that Orca was the dominant DEX on Solana like in 2022, 23. However, they have lost their leading position in the two most important verticals, which is both meme coins and the Sol USD trading pair. And although they dominate like in project tokens, stablecoin to stablecoin swaps, and LST swaps, the problem is that these verticals only constitute less than 10% of total DEX volumes. So even if they lead here, that's not very significant in terms of overall volumes. And then finally, we have like Meteora and Phoenix. You have seen that Meteora has benefited a little bit from like the meme coin mania. especially because they were the primary liquidity venue for the Trump launch. And then they were also the venue for the Libra launch associated with President Milei from Argentina. So I think like the problem here is that with every additional public figure that launches a meme coin, I think it's inevitable that we see decreasing marginal returns here. And like Meteora launched like the M3 platform for like a launch pad to compete with Pump.fun that was supposedly going to be fairer, and like it was supposed to like, I think the quote or the marketing like slogan was something like transform meme coins from a race to dump to a race to stake or something like that. But like the reality is like the launches on Meteora or M3 has had been just as bad as Pump.fun. And yeah, like that's it. If you see like the last thing we have is Phoenix, which basically has insignificant volumes in every vertical. So I don't think it's really worth to dive into that.
So something that I think is interesting I want to highlight is if we look at the recent data, if I just share our Solana Dash at Blockworks Research, you can actually see, I like that you highlighted Liquidity and their sort of dominance of the Sol USD pair. We've actually seen that shift like over the past few weeks towards, back towards your Orcas and even towards like a Meteora, for example. And I wonder if this is in part due to like a slight change in behavior of the typical user, if the meme coin activity is declining a little bit and we're starting to see that shift. Maybe they're not going through Liquidity just because these other dexes are potentially, if Liquidity is moving different locations, or people who are operating via these dexes are just moving their activity to that versus interacting with meme coins. I guess looking forward, the other like big kind of elephant in the room was the Pump.fun announcement of their own native AMM, which is a big question mark for Raydium, right? I guess Carlos, Mark, I know you guys did some work on this. Curious, like, what are your guys' high level thoughts, and then we can maybe jump in more. I know we've got a new Raydium dashboard as well that we can walk folks through too.
I think high level, I mean, like what Carlos was saying about Raydium only dominating meme coins, but Orca has a good market share of stablecoin swaps and LST swaps. But another thing to note is that those volumes tend to be on the lower tier fee pools. So even you could probably dominate maybe 80%, 70% of those kind of volumes. But if the DEX that has the meme coin volumes are the 0.3% and above, I mean, like that's where the real money is going to come in. And I think Pump.fun, potentially bring out their own AMM. It's in beta right now, so I think it's like basically inevitable at this point. But I think that's the biggest story. Like Raydium is going to lose their highest source of volume, but also the highest tier fee generating pool, right? And Raydium was a very loved asset, last year, coming into earlier this year, because of the strong cash flows and the strong buybacks, right? And it's a reflexive flywheel in the sense that when Pump.fun launches as AMM, these buybacks are going to decrease in value, and then the token becomes less attractive, and less volumes means Jupiter might route less to them. So it's a dangerous flywheel. But I think on the next slide, I'll let Carlos talk about this one. I thought it was really interesting. We were like, okay, so what is the actual impact of Pump.fun going to be? Because we know that once the meme has graduated to Raydium, it stays there, and Raydium retains those volumes. So there's no fear from the big ones like WIF and the Bonk and these larger meme coins that, let's just call them blue chip or yellow chip, right? It's really like let's see what the impact is of the newer graduation tokens. And we have just shout out to the data team at Blockworks for like pulling this together so quickly. I'll let like Carlos run through it, but I think the takeaways here were really shocking. Even though we expected some level of this, it was still surprising.
Yeah, absolutely. Like shout out to Jacob for pulling this chart like in 30 minutes or like 1 hour. It was incredible. I think like the main question, like Mark said, we wanted to answer here was what is more important, basically. Like, is Raydium, like what is more important for Raydium, like the coins that already graduated, like Farcoin, Fog, or whatnot, or the new coins that Pump.fun continuously launches towards the DEX. And so what we found is incredible, and we found that 70% of Radium's total trading volumes comes from pools that are less than 30 days old. This was like an insane statistic, like for both Mark and I, because it shows like new volume is way more important than already existing volume. And the fact that Pump.fun is threatening to launch their own AMM means that Raydium will lose basically its largest source of new trading volume, which, as we can see here, is basically the most important, like, uh, yeah, like the most important source of their total trading volume. I don't know, Mark, if you want to add anything.
No, I mean, it pretty sums it up well there. And the only thing I can think now is that, okay, Raydium has been so successful with their buybacks. I mean, I think it was, 22% of their tokens, I think they bought back. Plus, they have their existing treasury, which they didn't actually like distribute. So they have a sizable war chest relative to other crypto projects, and it's where do they go from now, right? Given that the likelihood of this happening, what are they going to use their treasuries for, their funds for? And this is why I prefer buy back and hold than buy back and burn, because okay, buy back and burn is kind of like what traditional finance, like the Apples and the Metas of the world do, and it's a buyback yield. It's nice for investors, and it has a tax benefit over dividends. But for a crypto project, you can burn it, great, to reduce the circulating supply, but you don't get the optionality. So, you can always burn it again, but Radium can afford to do things like invest in R&D, do partnership integrations, more marketing, launch their own Pump.fun competitor. And it's because of their previous success. So I think it's not all gloom and doom because of this optionality that their cash piles give them. And it's mostly Ray tokens, and it's some USDC and some Sol. But I think it's not all gloom and doom. And the pullback, the drastic pullback in the price over the past couple months, and from the Pump.fun announcement, when Carlos and I were looking at it, we did a scenario analysis, and we think that the pullback was definitely justified, and it's still within fair valuation range, especially when compared to some of the other comps in this peer group like Orca and these others. So there is a kind of hope, but now the risk lies on team execution and how they move forward with that. I know there's some other things in the pipeline even before this announcement, but maybe, and especially in the downturn, teams love to build in the bear markets, but maybe they can come out of this with a more sustainable or even more competitive business model.
I do have one comment that I think is interesting in talking with some of the Raydium guys, I think on Twitter, but this idea that like even Pump.fun doesn't really own their end user. I think that's often a critique of something like Raydium, where I think for the most part, you don't have a large portion of users that are directly interacting with their front end. It's they're probably being routed via Jupiter, or maybe it's bots just arbitraging trades. That's a large majority of the volume for a lot of asset pairs. But there is this interesting idea that maybe even Pump.fun doesn't really have the leverage to their users that maybe the market sort of thinks that they do, when we know that so much volume flows through Telegram trading bots, consumer trading apps. Your Photons, your BullX's doing at least during the kind of height of the market a few months ago, on the order of several $100 million of volume a day through just those two, if not like near $1 billion on that Trump launch. Doing significant amount of volume on specifically, we know that 99% plus of all the trading volume on those apps is meme coins. And so, I mean, maybe that might be an angle for these other teams to explore, if Raydium needs to consider building out a consumer application. Like we've seen the Tensor team, they kind of have pivoted away from the NFT marketplace, and they're building, the Vector.fun consumer kind of trading application as well. So maybe that's the lever, or if it's different types of assets entering into the space and like being a kind of hinging on that focal point. I think there's a lot of talk about everyone is going to the RWA talk now, tokenizing stocks, different things of that nature. I guess if you can be the premier venue for that sort of activity, I think you'd also expect that to be a very highly valuable and like revenue generating opportunity in the future. It's just a question of who's going to actually be able to successfully do that.
I'm definitely in the RWA camp, but just on that point with the not controlling their users, not in control of that funnel. I mean, it's liquidity. Why do these Telegram apps route to Pump.fun or route to Raydium, or why do these bots do it? Right? It's because that's where the liquidity is. And if what we've seen is that most of the volume comes from new tokens, like trade less than 30 days old, then that's where the liquidity is going to come. And frankly, I think it's a bit bottist to say that, because I mean, these bots pay the same fees that users do. Their money is just as good as anybody else's. So I'm not fully convinced in the camp of that, but I do see the point, and I do think there is opportunity to maybe control the funnel.
I agree there. Like, it's a question of what you value most, like in terms of distribution. Like, Pump.fun has their interface, most users interact there. Raydium only has like the liquidity pools in the back end. If Pump.fun starts routing liquidity towards their own AMM instead of Raydium, then I don't think there's an argument to be there that Raydium still owns the user. I wouldn't think so. And like, thinking through the scenario analysis, like, one of the things that stood out for me specifically is that I don't see a scenario, like, personally, where Pump.fun launches an AMM and then Raydium has more volume 1 year from now than it has today. Like, in my opinion, it's like pretty bearish for like Raydium's trading volumes, like on a forward looking basis. But like, the caveat here is like, and I agree with Mark, Raydium has a very robust financial position, and they can like invest in R&D or in new user facing products, like you mentioned, Danny, with like the Telegram bots, or they could like fork Pump.fun and launch their own launchpad. Like, there's a bunch of things they could do to mitigate like this potential tailwind. And I think like they won't sit idle on their hands and watch Pump.fun take that volume. I think they will like do things to retain as much as possible that liquidity.
Yeah, I think that's a fair take. Before we pivot away entirely from talking about Raydium, I just wanted to highlight we do have a new dashboard up at radium.blockworksresearch.com. Go and check it out. It's like we all just mentioned, there's some takes for, some takes against their kind of future positioning now that the Pump.fun AMM is out. But this is a really incredible dashboard. We've got breakdown of financials, the dig into the tokenomics, the trading volumes, look at different pools, LPs, all of that. So I think if you're interested in learning a little bit more about Raydium, getting deeper into the weeds and understanding their sort of current position, and maybe building a thesis for yourself on where you think they're going in the future, definitely check out this dashboard. It's really awesome. Thanks to the Blockworks data guys for throwing this together. We can jump along from Raydium though, unless anyone has some last thoughts. There has been some other sort of interesting news that I think has kind of been a little bit glossed over just due to all the Trump talk on the timeline. But Base has had some interesting announcements. They just dropped this Flashblocks announcement, which is sort of being compared to like Solana shreds. There's a little bit of contention on the timeline around calling them blocks versus calling them like something more like shreds or like not blocks. I don't know. I think the ETH and Solana like communities love to argue over the technical terminology. We can kind of skip that discussion and just talk like more about the specifics here. But the big thing is really that these are sort of like pre-confirmation blocks where data gets streamed every 200 milliseconds, sort of giving a sort of like a realized 10x speed improvement over the like existing 2-second blocks today. And it's available on testnet, not quite on mainnet yet, but planned for Q2. I guess I want to dive into this one a little bit because I think, I know Dan Smith has commented on this point a little bit, but there's a lot of talk about how speeding up block times in general just lead to more MEV arbitrage opportunities. Like we would maybe expect to just see increases in trading volume on a particular chain. I know Shapiro, you have written about Airdrome and about Base in the past. I'm curious on your thoughts, like what this upgrade could mean for Base and, downstream impacts you think this has.
Yeah, absolutely. So, kind of the core trade-off here that's at play with lower block times was really, I guess you could say, the discussion around it began around 2022, 2023 with an A16Z paper around loss versus rebalancing. And so, effectively, with any AMM, um, the block time effectively determines the amount of time that an arbitrager has to successfully make a profit. And because of also the block time, um, effectively implements a minimum bound delay in like the rate that price, like the information of the price can be propagated. The result of that is that LPs typically incur negative loss or impermanent loss um, because for providing liquidity because of this delay in time that a DEX or an AMM can update the price versus where the price discovery typically occurs, which is on a centralized exchange, because that's where the most volume is. So as you lower block times, um, what actually happens is that you're increasing the frequency of the ability for arbitrageurs to effectively uh, make change the price so that it's in line with whatever the sex price is, right? And so when you actually lower block times, though, the rate or the percent of successful arbitrages decreases significantly. So if you lowered block times from, let's say, 2 seconds to 600 milliseconds, that would lower the successful rate of arbitrages by around 90% to down to around 30%. Um, but the downside, or but the upside is that liquidity providers for the AMM are not losing as much money to LVR. So what that means is that you can provide liquidity. Lower block times means that you can provide liquidity to a DEX and effectively make more profit, right? So I think for arbitrageurs, I think the result is the arbitrageurs actually have to trade more to make the same profit, right? Because in order to have a successful arbitrage, you need to make more money than the cost you pay, right? So the amount that you make for the arbitrage has to be greater than the gas cost. The gas cost, let's just assume it's fixed for the purpose of like this theoretically. With a fixed gas cost, if the profit is less than that, you're not going to take the arbitrage. So the arbitrageurs end up, they have to transact a lot more to make the same money, to make the same amount of profits that they would have before with higher block times. So then we've seen this in the data. Effectively, the result of this is that lower block times tends to lead to more arbitrage volume. And so long as Base can keep gas costs low, which their goal is to get to like 1 gig of gas a second, like then lower block time should then theoretically um, increase LP profits, decrease impermanent loss, and increase volume. So just across the board, it just makes AMMs better, more efficient, and that's critical because DEXs and AMMs, they're never going to be where price discovery occurs so long as LPs are not really incentivized to provide liquidity there. But if they are incentivized to that, i.e., they're not going to lose as much money from impermanent loss, now all of a sudden, right, you might have more LPs that want to LP a DEX. With more liquidity, that means better execution for traders. That means traders trade more. They generate more volume. More volume means more trading fees, and more trading fees means more LPs are going to want to LP there to capture those fees. So I think lower block times is great, so long as you can keep gas costs low. And I think that it could start, like a virtuous cycle that just kind of grows the pie for everyone and really, potentially reach closer to the end game of like DEXs actually being where the price discovery occurs as opposed to on centralized exchanges.
I think those are great points. The other, maybe the sort of downstream question is, like, if we think about the venues on Base, and how they might be impacted. So, like, if we're going to see, a potential increase in just generalized trading volume, due to this what is like effectively a somewhat of a faster block time for the users essentially. Do we where do we expect, or how do we expect this to impact sort of the on-chain economy building on Base? Like Airdrome and Uni are like the two key locations today. I know you've written about Airdrome in the past. I'm curious if we still think that like Airdrome remains that primary venue for activity, or maybe even grows its share if they're doing, if either of these places are doing anything specific to capitalize on this, or just their existing share, like we would expect that to grow if they're currently the market leader.
Yeah, we'll see. I think, I mean, something that we do have, and we have data on this. You can show the charts. Like Aerodrome, I believe 83.3% of its volume comes from ETH, an ETH USD pair, ETH BTC pair, and a BTC USD pair. So the vast majority of volume that Aerodrome does is just effectively Bitcoin and ETH. Uniswap on Base, the vast majority of its volume comes from meme coins. So, without commenting on like which one I think will do better on an absolute basis, on a relative basis, you would think that lower block times would benefit Aerodrome more, because lower block times primarily benefits arbitragers, and that leads to increased arbitrage volume. And you're going to see increased arbitrage, or you're going to see more arbitrage opportunities for an ETH or BTC pair rather than memes, right? That primarily only trade on chain. So on a relative basis, I think Aerodrome, right, already captures around like 63% of all volume on Base. Lower block times, so long as the volume by pair type holds, I think would disproportionately benefit Aerodrome over Uniswap. And I mean, right, like also you could say like Base, they're dropping this block time. This is kind of, I think it's the same block time, 200 milliseconds as Unichain. So, I think the trend of Aerodrome being the main AMM and exchange on Base, I think that this will just accelerate that. And I mean, I would expect, Unichain to start to become the more dominant hub for all the Unichain pools. So we'll see what happens there. And then I did see you brought up another chart. I went and just kind of pulled some data together. It's not perfect, but looking at what percentage of ETH USD spot volume Aerodrome does versus this is versus Coinbase spot, Binance spot, OKX spot, and Bybit spot, and you can see that it kind of hovers. Recently, it's around 10%. It's been as high as maybe like 35%. And so, if you just modeled out different scenarios, right? Like you say, lower block times, theoretically, it's more efficient to provide LP or to LP Aerodrome. If it's trading a lot of fees, then you might actually, run the numbers and be like, oh, actually, maybe I should stake my ETH or LP my ETH on the ETH USD Aerodrome pool and maybe lock some Aero tokens or something. And it offers a nice APR. And so you decide to do that. And so maybe you could see this ratio increase from maybe like 10% to maybe you get more consistently above 20%. And right, because ETH USD and Bitcoin, that's like around 80% of their of Aerodrome's volumes. If this ratio of DEX to SEX volume for Aerodrome specifically, like if it doubled and kind of held there, that would effectively be like a doubling in revenue from trading fees.
Yeah, good points. Oh, go ahead, Mark.
I really like the outlook on Aero just based off of this. Do we have a rough timeline for when this non-shred upgrade hits mainnet?
Yeah, it's supposedly Q2 for base mainnet. So fairly soon. I do think that does keep with kind of in line with the general sort of like pace of base improvements. I know at least as well for 2025, they're also basically expecting to increase generalized throughput, whether that's via gas or total blocks times on like the relative order of like 10 to 12x as well. So, and we shared earlier that gas throughput chart, like they've just been continuing to step function that up kind of week over week. I want to jump back to, since I think it's relevant actually to the Solana conversation that we were having, but you mentioned some of the metrics around meme volumes versus ETHUSD volumes. So from our base dashboard here at Blockworks Research, probably the big thing to note is that like the ETHUSD pair is incredibly dominant on base, like upwards of 50% of the volumes in many cases. And memes have really just been a declining share ever since it launched, and the bald token rugged like that first week of the base launch. But yeah, I think when we look at like DEX volume by project, like as Shapiro mentioned, like Aerodrome really had a massive run last year and gained a ton of dominance, and has since then really just maintained this like 60% plus, 50 to 60% share of overall volumes. And then when we look at the individual categories again, comparing Uniswap and Aerodrome, you can see, like you mentioned, the meme activity was very highly concentrated around Uniswap pools, and that has dropped off. Like we've seen, memes have meme activity has started to drop off as well on Solana. In this case, it's been more strongly like we're seeing a ton more ETH USD pair volume here. And in the case of Aerodrome, actually, we've seen other pairs start to proliferate in recent times. So what used to just be like massive ETHUSD dominance is now getting filled in by some BTC, ETH BTC, and even project tokens kind of cropping up into the mix. So I guess it's interesting to see that both applications are seeing a little bit more proliferation of different types of assets. We're getting away from like all memes and all like just ETH USD pair. So that could be a positive sign for just base generally going forward. If we're getting away from just this like kind of bimodal distribution of assets where it's either all Pump.fun maybe styled memes and all ETH trading, and seeing more of like an ecosystem start to develop around that. Let's see like going forward if that continues. But overall, I think just re-highlighting some of the points you made there, and highlighting the dashboard we have. Thanks again to the data team.
Yeah, and Danny, on that point of right, like we're seeing these new assets crop up. I think of that Bitcoin volume that popped up there was because Coinbase brought like an on-chain, or they started their like on-chain Bitcoin loans with Morpho, and so after that integration, I think Morpho's TVL like 5x or 6x from like 30-ish mil to like over like 150 mil, right? And so this is something that I know like Brian Armstrong has sent out a few tweets saying that they want to integrate Base more closely with the core Coinbase product itself. And obviously like these like on-chain Bitcoin loans, Bitcoin-backed loans with Morpho was one example. And it seems like the Aerodrome team is like hinting at a bunch of stuff, but in like Brian Armstrong tweeted out that they could theoretically connect Base liquidity to the actual like Coinbase main product, and if it would provide better execution, they could actually like route trades to the Base backend. And so I think my guess, and like obviously I have zero information here, but for something like the ETH USD pair, like if you go and you click like buy ETH on Coinbase or your Coinbase wallet or whatever, maybe in the future, right, like they actually connect Base to Coinbase in such a way that they could effectively use the Aerodrome ETH liquidity for that trade. And so I think that Base, I think that's one way where these Base coins and just the Base ecosystem in general could really like strongly benefit from I guess like the Coinbase partnership, right? Is that it's beyond like they're not just going to get distribution in the form of like you install Coinbase wallet and like the first thing that pops up is like go swap on, Aerodrome or go get this loan on Morpho or whatever. But they could actually begin to route liquidity there. And so that's a form of like automatic distribution that I think could like really take some of these base apps to the next level. So I think that's something to watch out for.
Yeah, that's a great point. I was overlooking the CBBTC launch and integration and Morpho integration here, which makes total sense why we see the kind of BTC pair upticks. Kind of to your point, if we see if it's different Coinbase wrapped assets or just other assets that they are building out, promoting on the exchange and then bring to base, like it wouldn't be surprising to see like the growth of different pairs. Kind of based on those continued rollouts of potentially different products going forward. I know there's also this, Brian Armstrong has mentioned in the past, like this idea of doing like a token index, like a crypto 50 index or 500 index. That might be another example of, if you could roll up a bunch of these different types of tokens and get them tokenized and have them on base or have this index value on base, like just another scenario where, you might be able to take a bunch of these disparate assets that, currently you can trade on the exchange. Like you said, I think we're just going to see more and more that they leverage base the chain as an opportunity to get their retail users on there and make use of different products and leverage the sort of underlying smart contracts or like back-end tech that exists there for a relatively simplified user experience. And Morpho is like the first kind of clear example of that, but I think we'll see more and more like the other kind of recent chatter around like using USDC as gas, for example, on base and trying to simplify some of that user wallet experience in the Coinbase wallet app, for example.
Yeah, I think it also helps that Coinbase Ventures was in the rounds for Morpho, Aero, and Circle. So very, very nice flywheel for them there too.
Yeah, I think I tagged a bunch of the Coinbase Ventures portfolio products in a report before. So sign up to BWR to get that alpha. But yeah, you're absolutely right. Like there's a flywheel there. There's a shared incentive, and yeah, we'll see. I mean, I think base is like we forget how young base is. It's a very, very early, like a lot of other chains at the same time in their life cycle weren't as developed. Their ecosystem wasn't as developed as bases. So, especially if we're in this kind of like mini bear market or extended pullback, whatever this is, like they're going to be building. And I think Coinbase they're in the clear from a regulatory standpoint. So who knows what they're going to come up with? Like Danny, like you're saying, like the Coin 50 thing, like a tokenized, single product you could buy. Like I would buy that on Coinbase in a heartbeat, right? And so I think that a lot of that stuff is going to be legal now for them. So definitely some tailwinds there.
Have you been getting silly on chain this year, farming on 10 plus wallets across different ecosystems? Well, Crypto Tax Calculator is here to help. Crypto Tax Calculator has 3,000 plus integrations to support all of your wallets, exchange accounts, and on-chain activity, and a custom pricing oracle to handle even the most chaotic portfolios. Get started today and make tax season easy. You can use our exclusive discount code BW2025 to enjoy 30% off all paid CTC plans until April 15th of this year. Follow the link in the show notes below to get started. Yeah, the other big thing that brought it up earlier was this idea of getting we love to call them real world assets. I think it's really hilarious, but like, stocks are also relatively digital as well at this point. So it's kind of funny to call them real world assets, but either way, there's a lot of discussion of like bringing tokenized stocks on chain. There are some teams building different products here, like in DeFi today. I guess the bigger question, maybe for y'all is like whether we think that has relative success, or if you would just expect, the sort of giants of the industries today to come in and, build out their own products or buy up those products that have been built out on DeFi rails and, put their brand on it and, market it to consumers and institutions. Because I think that's really the big question of, Robinhood and even Coinbase, for example, they have massive sets of users and a big moat around that, and large funnels to where if they did end up being able to, and then offered like tokenized stocks on their chains, for example, like if Base had tokenized Apple and Tesla, and you could just trade that, and then you didn't even need this. If Coinbase didn't even necessarily need a more traditional like brokerage offering through their exchange, that's a pretty interesting sort of way to go about doing it for them, if the new sort of regulatory regime allows for it. Robinhood, I think, is maybe the opposite example, where they sort of already have all that existing brokerage stuff in place. They don't have their own chain, but they could go the reverse route of building their own chain and doing that stuff on chain. They're sort of maybe on opposite ends of the spectrum. The other question is like, does BlackRock or Fidelity, or like pick your favorite, if Vanguard, come in and wave their massive pile of cash and assets and and AUM around and just say, no, we're going to do this and we're going to be the dominant player? Curious, any thoughts there? I think I've seen some different. I think Mass Money was one that kind of went around socials a bit the other day around being able to trade like these tokenized shares on chain, on like EVM chains, and just some of the different things like the KYC requirements, this being in DeFi, not having like the backing of a large institutional partner. It just makes it a little bit tricky, I think, until you see the kind of major institutions come on board and say, and get the backing of maybe the regulatory regime to say, yeah, this is okay, like let's do it. If it makes it a better product experience for your users, then go right ahead.
I think for now it might be an interesting pilot. I mean, with stocks, I mean, we're looking at retail here because they're most likely for on-chain products, and they're interested in tech. Apple, Tesla, these kind of big assets already have so much liquidity existing, like off-chain, and the fees are already so low. I mean, Robinhood is free, selling order flow, and it's free. So I feel like it's probably the lowest hanging fruit, but the rewards aren't too high for that. I mean, especially for US citizens, like you go into one app and there's, you can trade stocks or crypto from one app. You just click another tab. So the convenience is right there. For maybe international investors, it's it's not dissimilar from an ADR, which is kind of like, if you're a US citizen and you want to trade Chinese stocks like NEO or Alibaba, what you're essentially buying is an ADR, which is just a wrapper. So it's somebody else who's bought it, and you buy that, which is basically some form of tokenization. If tokenization is just wrapping it. So for maybe then it might have some use case, but again, like US has most of the volumes, most of the revenue, and like that's probably going to be your target market for launching these kind of products. And I think it's a little bit more interesting to probably do private equity market, something that traditionally hasn't had enough liquidity or any liquidity, and bringing that on chain. But I think the complication there might be around like capital calls. Like you have this hedge fund. How are you going to have it in USDC? Is it going to be interest bearing? How do you move that to these private equities? Every single company wants to have their own chain to control the funds. Will they use a public blockchain? Will they have their own private chains? What's the interop solution going to look like that for that? So that one is not as easy to do, but I think the benefits of tokenizing assets are much more clear for those less liquid instruments. But if we were to go the public route, I would kind of agree with what you said in the end, where it's probably going to be like a large company like a BlackRock who has liquidity, who has customers, who has all of the needs necessary to bootstrap all of this and hit the ground running. Maybe in their circumstance, it can work in lowering fees and having those volumes. But I still think it's going to be pilot projects. I think after the stablecoin bill passes this month, we're going to see a lot more of that, because stablecoin bill is you're just tokenizing a US dollar, right? I think next steps will be hopefully tokenizing deposits, and then you just go down the long tail end to these other things as well.
Yeah, I couldn't agree more with what Mark just said. I think like, especially for like non-US investors, it could be beneficial. Like if you're in the US, you have every facility to invest like in stocks, but like for instance, in my case where I'm not US based, like having it on chain, I see benefits in terms of like the fiat on and off ramps, and how it would be so much easier to just like buy a, I don't know, coin stock from my wallet than having to withdraw that money to my bank account, push an international wire to like Charles Schwab or Robinhood or whatever, and then like invest from there. Like it would be so much easier to do it like from a wallet with my USDC, which where I already have like my money. So I agree there, and I also agree like on targeting more emerging or niche markets where like are somewhat unattended, like private markets. I think there was a company called Action Nariad, like in Switzerland, which already does this, where they tokenize like private equity, and you can trade that. But like one of the challenges of these sort of like innovations is that you have to remember, like for real world assets, uh, the biggest hurdle is regulatory. So you gotta make sure, like when you trade this stock on chain, there is also an off-chain like legal mechanism that grants you the ownership of those shares. So basically, how do you equate like the on-chain world with like the off-chain laws, so that when you trade something on-chain, you also have like legal recourse off-chain and have that ability to like actually say that you're the owner of that portion in this instance.
Yeah, the growth in emerging markets, I think, is a great point, Carlos. And we've kind of seen the same thing when it comes to stablecoins, right? Like there is usage of stablecoins, obviously, in like the U.S. and pick your other like dominant first world nations. But when we look at like usage of solutions like Tether and other stablecoin like applications for sending international transfers, things of that nature, that like may not really be as much of like a U.S. citizen problem. They've been quite successful, and so maybe that early like user set or like really interested user set is again from that emerging market perspective, where like, if I'm a US citizen today, like, yeah, I can go get a, Vanguard account, I can get a Fidelity account, I can use Robinhood, etc. There's a million places, right, where I can go and trade stocks and also crypto now in a lot of these venues as well, that they've been opening up. So it may not be much of a pain point for me, and the real unlock there might just be, around some of the other features that putting this stuff on chain enables, like, rather close to instantaneous settlement, and the money is immediately there. You don't have to wait for like ACH transfers, things of that nature. Maybe it lowers the fees on the back end a little bit for the business itself. Those aren't really like the strongest benefits that are going to drive this all the way to the, like, take this from 0 to 100, but it could be the users outside of the US who maybe have a difficult time access these things through their legacy systems today. If you open that up a little bit more, they might be that key like initial kind of onboarding set of users that are willing to test it out, and build some PMF around it before businesses at scale make use of the tech for sort of a fees based and like cost savings kind of benefit on the back end. And I think that's kind of what we've seen with the slow growth of stablecoin adoption. It's really taken off. Like in the East and in the West, it's like we've been going through this like slow regulatory hurdle. There's been some adoption here and there of like, yeah, these actually do make sense. Like it's instant for me to send a payment, and I don't have to wait a few days for it to land in my bank account. But outside of that, like we've just been going through the slow motions there.
Yeah, I think that like unequivocally, we're moving to a world where all assets are tokenized, right? And they're not known as like real world assets, right? Like those are just assets. And so really it's just a question of how you do that, right? I mean, first, like the benefits are obvious, right? Like, yeah, I can go on Robinhood, I can trade stocks and crypto, but like I can't go deposit my stocks into a DeFi app. I can't go earn yield on them. I can't take a loan out against them, right? Like tokenizing them gives them infinite more utility for the asset issuer themselves. If they tokenize their stocks, they get T+0 settlement. They have reduced fees, um, and they have full transparency of where that asset is and what it's collateralizing, what it isn't. And so after '08 with the Dodd-Frank Act, effectively every bank, other financial market infrastructures, they need to keep like maybe as high as like 1 to 2% of all their assets just as like just like in cash, just to make sure that like if they're if like the pipes just or effectively like grease the wheel, right? So like if the system, if there's like some form of contagion somewhere, right? Like there's enough liquidity to like keep the system going, right? And so like that's like a bunch of latent capital that could be getting put to work, right? So the fundamental incentive for all of TradFi to tokenize is there, and it will happen. It's just a matter of how. So like when you buy a stock on Robinhood, like they're the custodian, right? So like something like Coinbase could do is, right, like they could become a registered custodian, like they could go buy billions of dollars worth of like the FANG stocks, and then they themselves could wrap them, use do like something like with proof of reserve to prove that like the tokenized version, or like the real version of the stock is like sitting there in custody, and then you can go use like the tokenized version, right? So that's like one way it could potentially happen. um, and this actually goes back to like the Raydium Pump.fun thing, is like who has the leverage here? Is it Raydium who has the liquidity and the technology and the pools and the assets, or is it the front end, right? And my bias is more towards like who has the liquidity. And I mean, this is effectively like if BlackRock has $10 trillion worth, 10 trillion of assets under management, whatever, and like a large portion of those like are, let's say, various financial products that like people want to buy for them, like what is stopping them from potentially making their own chain, tokenizing all of their assets, and then using an interoperability solution for people to come and buy them, right? And so I mean, like the other, right, as opposed to all these individual um, tokenized asset platforms or whatever, the alternative, and I guess you could say the alternative approach that's been years in the works is Chainlink strategy, with CCIP, and now with their CRE, their runtime environment, where they're going to effectively create a platform for any TradFi institution to tokenize their assets, and then to connect together with their already existing infrastructure rails, with their Swift messaging system, and then effectively CCIP is just an extension of that. So I think those are like there's various paths for where of how it could occur, but yeah, I mean I think 10 years from now, it's not this Web3 and TradFi and crypto and whatever. It's just a single unified blockchain based financial system, and everything is just assets.
Yeah, and just to add one point to that, I think I definitely agree with you. And I think in that time frame, it's not going to be tokenizing assets. That we're going to skip that. The ATS will be the DLT, and we're just going to list the assets directly on chain. There won't be any counterpart on some other database somewhere else. It'll just be directly on chain listed assets. But we're far from that now.
Yeah, I guess you sort of have a starting your own AMM like Pump.fun problem there, where all the existing assets, you have to work through those, going through having two ledgers, and then anything that gets created new can start out on that one and have no problems. But yeah, there's sort of like the legacy issue there that we'll have to, if that is truly the future, then we'll have to work through the legacy issue there. Maybe just one note to make fun of the idea about adding transparency to a lot of these things. We might need to work on some of our block explorers. I think there's very few people. Maybe Dan Smith is one of the only people who can read the Solana block explorer today. We might need to work on some of that transparency, especially as well around token unlocks, who owns what, in terms of insiders for different tokens today. I think we would have problems if it was not easy to tell who was the owner of like a large stock, for example. I think we're going to need to make sure we work on some of that stuff. So just things to work through. The data is all out there. There's a lot of blockchains and blocks to read through at this point, and somebody's got to do it. Awesome. Well, great up, guys. Anything else? Maybe any key takeaways from anyone on the call to leave off the viewers for today, or a dash shill if you're going to be there.
Just keep grinding. It's not a guarantee that we have these like cycles anymore, and so I don't know. It's like trying to square all this negative macro stuff that's hitting us, while at the same time it feels like even if Trump like as we started off, like with the strategic reserve with some kind of not decentralized kind of scammy assets in there, like whether Trump is like truly promoting crypto in a positive light or like a scammy light, whatever it is, like regardless of that, like I think like there's now there will be a framework for the good actors to actually start building. And so like I think just stay locked in and I don't think like now is the time to just be like, oh, bear market, I'm gonna disappear for a year.
Yeah, I'm gonna second that. This is the best time to probably be following what's going on. I mean, we're finally under an administration where the regulatory agencies aren't stomping on the neck of the crypto, and even if they just let their foot off, they're not even doing that. They're helping the entire industry up by the hand, right? They're putting us up on a platform. So it is the government, and it's not going to be very cypherpunk of me to say this, but it's good to have them on our side, but it's the government, so it's going to take time. It's not a very quick endeavor, but even in the past week, we've seen a lot of SEC cases dismissed, and there are different crypto task forces working on various things, and the lobbying industry is pretty strong. So I think kind of like zoom out as always, and I think it's like we have some structurally positive tailwinds ahead of us for the next couple of years.
Yeah, I like that. Near-term sentiment is, observedly very poor at the moment, but like Mark said, it seems that long-term sentiment for crypto has been more positive than it's ever been, with the positive regulatory regime kind of stepping into place here. So yeah, like both mentioned, this is the time to, survey the landscape, figure out, what are going to be the interesting, if it's assets or chains or ecosystems going into the next few years. Now is the time to be looking around, nosing around. Take a look at that Raydium dashboard, raydium.blockworksresearch.com, and take a look at all the other dashboards. We mentioned the base one as well, but we will see you guys again next time. Appreciate you all for watching, and thanks you guys for coming on.
Thanks, guys.
See ya.